You know when the news tells you about a soft landing is most likely? Well, that means a hard landing is most likely. Let's discuss protecting yourself in this video. Listen to Bank of America CEO and then Mohamed El-Erian on his comment on it.
The debate investors have been weighing is whether the economy is currently experiencing a soft landing or even no landing at all. It's a question that was posed to Bank of America CEO Brian Moynihan earlier on CNBC after the company's better than expected earnings. Take a listen.
From what we see and what our experts tell us, we took it's no landing might be the best choice if you're thinking it gets down about 1.5 to 2% growth, which is where it was sort of for a lot of years prior to the pandemic. If we can glide into that level and keep the inflation, which is down a lot now, continuing to move down, that would be a no landing.
All right. Well, joining us now is Mohamed El-Erian, Chief Economic Advisor at Allianz. Mohamed, it's great to have you back on the show. I want to get your response to what we just heard from Brian Moynihan, because I can't recall us hearing from a bank CEO that has such insight into so many different parts of the economy talking about no landing.
No, what he just said, Morgan, and thank you for having me, that would be a soft landing. That is, in fact, the definition of a soft landing. A no landing has two variants. One is that growth stays high and inflation stays high and the Fed tolerates it. And by inflation stays high, we mean 2.5 to 3%. There's another no landing, which is the really good no landing, which you get positive supply shocks and we are bigger but not hotter. And that has about a 15% probability of happening.
What would it take for that to happen?
I think we need the productivity enhancers from AI, from life sciences to come earlier. We need to continue to have positive shocks to our labor force. And if we get those two things, you can get the bigger but not hotter economy, which actually would be perfect for almost everything you can think of, from households to companies to financial markets.
I mean, no one's even really talking about recession anymore. It seems to have gone out the window and rather quickly here. So what are the key factors that you're watching through the end of this year and into next? I mean, inflation, for example, we just had Thomas Petterfy from Interactive Brokers on, and he basically said he doesn't think inflation's dead. Can we ring the victory bell on it yet?
No. So my probability of a soft landing is 55% and a recession 30%. So soft landing is the most likely, but it's not a dominant scenario. Why isn't it dominant? Because we have weakness in the household sector and the lower income side. And the Fed has been all over the place. Just think, Morgan, end of July, the Fed doesn't hike, doesn't cut because everything is fine. Next meeting, mid-September, it suddenly cuts by 50 basis points. And now it is talking about cautious cuts. So, the Fed's got to be careful not to increase the probability of something going wrong. But soft landing is the most likely. The economy is strong, corporate earnings are strong, and on top of that, we have well-behaved oil prices, and we have the hope that China may stimulate the economy, helping to boost our demand.
The oil prices piece of this is particularly fascinating because we saw a jump in crude and then we've fallen pretty quickly here as it would seem geopolitical risk is ebbing, not to mention you have an OPEC cut to the oil demand forecast. How much hinges on those prices staying a bit more depressed, which also seem to be, at least in trading today, pushing yields lower?
Quite a bit. High oil prices can complicate things. They would, of course, take up headline inflation, and then they would start feeding into higher production costs. In terms of where we've been, it's been about geopolitics. On September 10th, WTI was at $65 a barrel. Why? Because people were worried about demand, especially a weak Chinese economy. Next thing we know, we were all the way up to $77 a barrel on geopolitics. And now we're back down to just under 71 on geopolitics. So the geopolitics is the volatility enhancer. The underlying price of oil is being undermined by weak demand out of China.
How much hinges on the election and what the policy picture starts to look like for 2025 and beyond?
So the market's pretty relaxed right now.
The market is pretty relaxed right now, which is exactly why it's time to hedge and protect yourself. I don't believe the news. I've mentioned how they lie about inflation data and they underreport. I would buy value stocks as a hedge right now. Hand over fist, guys. Hand over fist, value stocks. I would protect yourself, hedge your portfolio, bicep over tricep, be protected, okay? El Arian, he suggested that for a no landing scenario with strong growth and low inflation, technological productivity gains from AI and life sciences alongside long labor improvements have to happen. That was a long sentence. That was a long sentence because a lot has to happen for a no landing. And he mentioned like a list of so many things. Guys, I don't think we're gonna get all of those things. I don't think we're gonna get a soft landing. At some point, we're going to get a strong correction. I don't think we'll have low inflation. That's a joke. I don't think we're gonna get low inflation at all. And productivity gains are not guaranteed at all, okay? So I would look at XLU. It's a hedge right now. The utilities, because as interest rates fall, XLU is likely to go up. And also, you can still hold Mag 7 and all the stocks that I recommend, but think about going higher delta on your covered calls. Because look, when you sell covered calls, that is a hedge in your portfolio. It's a hedge because you're collecting income. That income is giving you cushion, margin of safety, and that creates income and margin of safety that if the market pulls down, hey, everyone's gonna lose money. I'm going to lose money. Everyone's gonna lose money, but the covered calls at least help you lose less money. Ilarian criticizes the Federal Reserve for being overly data dependent, suggesting that their recent decisions, such as the 50 basis point cut, were likely too reactive, which I've said that would be too reactive, but he said it'll be too reactive and could have been more measured, all right? AK, they're going fast, guys. They're going fast, and they're not really doing the best job at what economists call a soft landing. So exactly what I said a month ago in my videos, and look, guys, let's be real. When mainstream news touts a soft landing as the most probable outcome, it's essential to remember this is often a signal of a hard landing being more likely. So the soft landing talks really make me nervous about the stock market because I'm bullish. You know, October was a great month. November is an election year, an election month. So when they say, you know, we're gonna have a soft landing, and I see we have an election, you know, I'm being very cautious, and I'm uncertain what's gonna happen. So the current relaxed state of the market is actually kind of troublesome. Complacency typically precedes significant downturns, making it crucial to hedge investments right now. Because when you see complacency, volatility is low, you know what's around the corner. Many believe inflation data is manipulated and underreported, leading to false sense of security that could contribute to a market crash. And I am one of those people as well. I think that we are getting a lot of inflation that is underreported. Although I don't speculate too hard on the market and I try to predict it, I am definitely positioned right now as a more defensive investor, and I've always been more of a defensive investor. You know, in the early days, and I showed you guys a recent video on my YouTube channel where I've essentially went through my background, my history, pictures of me in the Goldman Sachs office, and pictures of my 100K portfolio, picture of my 40% return in a month, and how I've grown from 100K to 700K back in 2020. That was higher risk, all right? But in general, since then, I have been a lot more defensive because as you build your wealth, as you have a six-figure portfolio, you really can't afford to lose that. Now, I get it. People that have 5, 10, 15K really can't afford to lose that, but that's obvious. When you get into the six figures though, that's where the rubber hits the road, right? Are you gonna scale from six figures to multiple six figures in 7, or are you going to plateau? A lot of people, they get good returns, but this human nature. They get cocky. I'm getting good returns. I know what I'm doing. And you get a pullback, and then they end up losing way more than they should, like way more than the pullback itself, because usually they're making a lot of money because they're taking on excessive risk, and most people can't see risk because it's invisible. Risk is it's invisible, right? I mean, unfortunately, that's how life kind of works. There's risky things that we don't know of. We're not aware of what we don't know, right? Unfortunately. Right? So there's certain things that will happen in our lives that we couldn't predict and that we didn't know we could even, that was like a possibility, right? So when it comes to that, you have to be defensive because being defensive means getting income, being consistent, growing your wealth, and actually reaching retirement. Because a lot of people, they have a bigger portfolio, but it's not really growing, or it's growing, but the money that they could be making is invisible. So I was talking to a dentist recently, and he was making $15,000 a month, which is pretty good. You might say to yourself, fantastic. But he has a $2 million portfolio. $15,000 a month is not a good return on $2 million in a month. And he was pretty happy, and I don't blame him. I mean, he has the assets that he needs. His income's $15,000 a month. He owns his house. Everything is fine, right? But I said, Doc, you know that you could probably make like 3% a month, which is $60,000. Like, you would go from being comfortable to being kind of like stupid rich. It took a while. It took a while to actually get through to him because, you know, he's obviously stuck in his patterns, and that's normal, right? We all get complacent, including myself, right? I mean, we're all humans here, but when you take a look at being a defensive investor, it doesn't mean that you're not going to aim for big results. It just means that you're taking calculated risk, and that's what it's all about, guys. Taking calculated risk, and everything I do is always I'm always 2 steps ahead, if you know who I'm referring to. Famous YouTuber Nikocado. 2 steps ahead, right? I'm always trying to take 2 steps ahead and be very deliberate about what I'm doing and take a data-driven approach. So I put NVIDIA and Palantir and Tesla into the safe category of being careful, because they have high momentum, and statistically speaking, I think that these stocks are going to rise. But everything else, guys, be cautious on. Sell covered calls around a 40 delta, because the expectation of low inflation is overly optimistic. I'm telling you, it's overly optimistic, and I've mentioned a few times, and I'll tell you the joke, okay? And I'll explain the CPI again real fast. So CPI is a basket of goods, right? In that basket of goods, you might have like an iPhone, you might have food, you might have education, healthcare costs, but it gets really specific as well. So, you know, eggs and corn and oil and gas price, right? And beef, etc. So look, the way that they can manipulate it, and I laugh about this, they take beef, right, as a cost, and beef rises in price a bit faster typically than chicken. Not all the time, but you know, it was the case one period. They replaced beef with chicken because they said that consumers' alternative to beef is chicken. Sort of. I can see what they mean, but at the same time, I think beef is a little bit more of a luxury good than chicken. I believe that to be the case. I mean, I do go out to restaurants every day because I do live in hotels and I travel. And gosh, if I wasn't making the money I'm making, it adds up, because you have a steak, you have dinner at restaurants all the time. I spend like $150 a day on food, I think. Yeah, like 100, 150, and that's not even like, if I go on a date, it's like double, right? And I'm living in not even an expensive country. When I was in Dubai, and I was spending like $500 a day on food, 400, 500, especially on dates. So the bottom line here is that they can manipulate CPI data because they can take beef and say, we're gonna switch it for chicken because it's an alternative. Guys, I don't know about you, but if you wanna eat beef, I wanna eat beef. I don't wanna eat the government to tell me inflation is low because they're switching chicken for beef. I mean, it's kind of deceptive, but that's just an example of how you can lie with statistics and data. This stuff can get really complicated. I'd also be really careful about listening to other YouTubers, because most of them, actually all of them, even the ones that do show their portfolio, they don't have a degree that actually backs it up. All right, so just be careful where you get your information from. All right, I'm happy for you guys to just learn. I'm doing my job to educate, but be careful. It's very easy to lie with statistics. All right, there's a lot of books on it, actually, lying with statistics. For example, one lie, by the way, that's very easy to tell people, right? I'm giving you guys some different value, and I'm mentioning different things that I know to make my videos, my content unique, right? Because I want you guys to really get something out of my content. So look, there was this book, I think, what's it called? Naked Statistics or something like that, whatever. Look, they took a look at kids dying, the death rate of kids, right? And then they took another statistic, which is ice cream sales. And they noticed that the higher the ice cream sales, the more kids died. Interesting statistic, isn't it? And the correlation was clear. Ice cream sales go up, deaths for children go up under 6 years old. And it's very linear. It looks like that, right? It's like that with some variation, right? But the chart is very clear. More kids dying, more ice cream sales. How come? There's something called the confounding variable. So there's a variable underneath. So it's not that ice cream sales contribute to kids dying. We clearly know that. It's that hot weather means that pools are open, so kids are more likely to drown in a pool. Because hot weather means it's summer, and summer ice cream sales go up, and because there's access to water in the summer, kids drown, all right? So that's why there's a correlation between ice cream sales and and kids dying, it's not the ice cream sales themselves, it's the warm weather that is the compounding variable. All right. So I just want to point that out. Be careful how you get your information and make sure you trust the source and also understand how data works. So when I look at NVIDIA and Palantir and Tesla, I put it into the safe category given my view. But when I look at inflation and what L. Arian said for inflation being like low, for there to be a no landing, I don't think so. I think we're gonna potentially have an issue in the market, a crash or a pullback, which is inevitable. It's gonna happen. And look, asset bubbles are normal. That's why I'm talking about it so calmly, because this type of stuff is normal. Asset bubbles happen, and it's important we hedge because it's hard to say where we are in a market cycle. You got a herd mentality. Herd mentality plays a significant role in forming bubbles, as investors tend to follow trends and the actions of others rather than conducting independent analysis. Herd mentality. Someone tells you, oh, buy this or sell that, and you do it, and then it's happening on a mass scale. So herd mentality occurs when individuals follow the actions or beliefs of a larger group, often leading to irrational decision making. As I see stocks hit an all-time high, I am more cautious, and a crash seems more likely to me. So I'll keep you guys updated. Make sure that you subscribe, and I'll have more research and strategies soon. So invest safe.